Hello, hello. So Crowdstrike had its earnings report, and the stock is actually down about 20% in the after-hours market. Pretty much devastated here, and it's a stock for which we have talked about a lot in the past. It used to be expensive, so after it's falling down that much, is it still expensive? We're going to examine that in this video. But the first thing to do is see what happened in the earnings report, because that's obviously very, very important here. See what happened with the company as it tanks 20% in extended training. You will see here what happened over here. The investors pretty much are punishing its current quarter guidance for revenue that came inside of street expectation, but also they did fall slightly short of estimates for annual recurring revenue. Now, as you will see here, the annual recurring revenue was 2.34 billion, which is up of 54% year over year, versus the consensus of 235, which is slightly lower, but still pretty high, and that's a pretty significant growth over here. But versus its year-to-date high, the stock is now down more than 50%. Now, what happened here with the financial highlights? The company has lost 55 million versus the year ago 50.5, so they seem to be losing more than what they lost in the Q3 of last year. So per share loss also climbed from 22 to 24 cents. And on an adjusted basis, EPS came in at 40 cents, but you cannot really take a significant look at the adjusted basis, adjusted EPS pretty much, because there is a lot of alchemy going on there. I have explained that in past videos. Just because they exclude a lot of the expenses that the company has, this is why you're getting positive values. Now revenue jumped 53%, which is pretty nice over here. Consensus was 28 cents a share on a 516 million revenue. And they did add 1,400, about 460 net new subscription customers over here. Now, the interesting thing, the guidance for the future here, you will see that they expect an adjusted profit of 42 cents to 45 cents on a 619 million to 628 million in revenue, which is more than the analysts had called for in terms of the EPS, the adjusted EPS that is again, but they had a higher revenue here of 634 million versus the expected 628. But the stock has been punished severely regardless of these results here, which do not seem to be super negative here overall. But still, amidst this current environment, you are getting these companies pretty much getting devastated with a slight miss. Again, because the market is overall pretty much tanking in the past year. Okay, so what's going on here with the company's financials? Now, we will examine the company in more detail. You will see here that the P ratio of the company is negative, meaning that the company is losing money, and it's getting a little bit better since it's what it used to be like a couple of years ago, but it's still fairly negative, and the price to free cash flow is very high. Now, of course, it is positive because of the adjustments, but it's still very high. And also the company has been issuing ton of shares because they don't really make a lot of money pretty much. And it is a $29 billion company, almost 30 over here. So you would expect them to make significantly more free cash flow here. And while it is increasing, a company that is $30 billion company making 400 in free cash flow, 400 million that is, that's not great over here. The good thing about it is that it is increasing, but it does look like it could still be rather expensive. Now, the company's revenue growth has been seeing some upticks over here, and it keeps growing very nicely. So that's a good thing about the company. And the total equity growth as well, because again of the outstanding shares pretty much being sold here. The company is not really making that much impressive net income, as you'll see here. It's actually negative. And the free cash flow again becomes positive after the adjustments. But the company is losing money, as it is right now. Now, the company doesn't have a lot of debt here, which is a nice thing to see. So they seem to be, they are not running on empty, which is at least a nice thing to see. But we can take a little bit of a closer look at the income statements, or I should say the financial statements. And you will see here that they are doing a revenue of 1.4 billion. You will see the massive increase here, which is nice to see, almost doubling in a couple of years, and then continuously increasing the revenue at a fantastic pace over here. And you will see that the net income, however, is getting negative, and it's getting actually more and more negative, which is a bad sign. This is something that you really dislike to see. Now, some companies could, on the hunt to more revenue, still, have a lot of expenses and, for instance, hurt their net income. But, you see a significant decline pretty much in all 5 years recently. And yeah, there is an increase in the revenue, but it doesn't get reflected in the actual money that the company generates. And that can be a little bit problematic, especially when you are heading in on a downturn pretty much right now, or heading to a downturn in the economy, in the overall economy. And this is why the company is punished so much. And the balance sheet over here, you will see what's expected in a balance sheet of that sort. The fact that the company is actually issuing shares, issuing tons of shares here in the billions. And they don't have a lot of debt, yet the total equity is about 1 billion over here, which is, compared to the total liabilities, less, because the total liabilities are 2.5 billion. So they have been increasing their liabilities significantly, getting on more debt, for example, and generally speaking, increasing the liabilities that the company has over here significantly in the past couple of years. Now, in terms of the cash flow statement, is what we talked about earlier. As you'll see here, the net income has been negative. And after the adjustments for mainly depreciation, amortization over here, and stock-based compensation, the usual suspects, pretty much, a little bit of change in working capital as well, you will see that the operating cash flow becomes positive. Yet, if we take it down to the free cash flow over here, you will see that it is increasing, but still 400 million for a $30 billion company sounds expensive. And we'll examine that, of course, in a little bit more detail later. Now, you will see here that the net cash from financing activities is 70 million over here, so not much going on here, pretty much. Just issuing a little bit of more shares over here. And in terms of investing activities, they are purchasing investments over here, and capital expenditures is the main gist of it, pretty much. As you'll see, some minor acquisitions here. If I should say minor, it's 400 million. It's not that minor. And the next thing that I want to examine over here is take a look at our stock evaluation tool. And this is not a company that is paying dividends, so the dividend discount model doesn't really apply here. But it is a company that is producing free cash flow, of course, as most companies do. And what we need to see is whether it's a buy today based on the free cash flow that it is producing and based on the financials that it's producing. So the revenue growth of the company has been impressive, yet when we are projecting here, we want to be lower, not too low. We don't want to overdo it, because we're going to get weird results if we do that. But we still want to go low, so I'm going to go 10, 15, and 20, which is not low. It's pretty high, but it's low compared to what the company's revenue growth has been over the years, which has been impressive. So still, 10, 15, and 20, I think it's very, very achievable, and the company could achieve more, frankly. The big problem here with a company of this sort is the net income margin, because as you'll see here, it's negative. The company is not making net income. It's actually not making profit. And so what can you do here? In such a case, the only thing you can really do is come up with sort of like marginal net income margins here. So you're going to do something like 1%, 3%, 5%, and see what you get out of these ones. And this is what I'm going to do. So I'm going to go 1, 3, and 5. And remember, the company is not close to achieving that right now. The company is actually losing money, and their margins are negative. And so this is a very, very optimistic scenario. So super optimistic here, super confident, just to see what kind of price to pay today, even if we are extremely confident for the company. And the free cash flow margins that I'm going to use, again, we cannot really use the statistics, the financial history, because the company hasn't been making money. And so when you are generating free cash flow from net profit that is negative, that's not a good sign, because you know that it is from adjustments. And so what we will use here is something that is typical, 80, 90, and 100, something that I typically use for companies, and you see it with most companies, something close to 100 or 90%. And an annual return of about 13% is what I want to be getting out of any single stocks. Now I hit calculate, and what am I getting? And you will see that, as expected, this company, compared to what it produces, when you actually account for the free cash flow that the company produces and the net income that generates, which is negative, and even if they had positive margins, which they don't, this is a company that is like a $5 to $10 company, and it's currently sitting at 111, I believe, is the current price after the drop to today, which is going to be at about 20%. So as you can understand, this is extremely expensive, and you could get an easy sense of that when you take a look at the initial metrics here, just because the PE ratio and the price to free cash flow tells you that the company is significantly overpriced over here. And again, a company that is making less than $500 million in free cash flow and has a market cap of 30 is probably a pretty expensive company. And so this is what's happening with this one. it is a company that you cannot be investing right now, unless you are trying to find the next lottery ticket. It doesn't make a lot of sense because it doesn't produce enough to call for this current price that you should be buying it at if you bought it today in the market. So that's what I wanted to say about CrowdStrike. Let me know what you think about the company. Leave a comment below, and I'll see you in the next video. Bye bye.